Welcome to the Real Impact Podcast. I am your host, Kyle Troyer. My goal is to talk multifamily real estate, help you think bigger and take action on your goals, and give you tips on podcast creation and strategy. Please follow, like, and subscribe, and leave a review. That would mean the world to me. Share with someone that could benefit from this podcast.
Hi, and welcome to another episode of the Real Impact Podcast. Today, I'm going to talk about why I love commercial real estate and also talk about how it works. First of all, I'm going to tell you why I got into commercial and why I like it better. I started out with a duplex and it caused a lot of challenges for me. One of the reasons I love commercial is the ability to predict a future value with cap rate, and we'll get into that later, versus residential where the value is based off of comparable sales in the area. So it makes it easier to predict a future value in commercial real estate. I had some challenges with the duplex, so just a lot of different things that I won't go into, but I ultimately ended up selling and invested some of the proceeds into an apartment building as an LP investor. And we'll talk more about that later as well. So defining commercial real estate when it comes to apartments, anything with 5 or more units is considered commercial. Anything with less than 5 is considered residential. And we're going to talk specifically about apartments today. First of all, let's talk about some of the key distinctions that you might have heard. First of all, let's talk about some different myths and misconceptions regarding apartments. A lot of people think you need to be super wealthy to invest in an apartment building, and that's just not the case. Have you ever looked at one of these big apartment buildings or office buildings or industrial spaces? You might think that it's just one wealthy owner that owns all of that, but the truth is majority of those assets are actually owned by multiple investors in a syndication. And we'll get into the syndication later as well. Another myth about real estate is that it's completely passive. Now, it can be as an LP, but as an operator, it is anything but passive. There's a lot of work that goes into managing a property. Even if you don't manage it yourself, you still have the asset management, the operations, investor relations if you have investors on the deal. So a lot that goes into that. So the difference between property management and asset management is property management is more of the day-to-day operations, collecting rents, fixing toilets, things like that. Asset management is more big picture decisions, talking about business plan, how to increase value, investor relations. And so there's a big, it's really important to focus on asset management, and that's where a lot of the work comes in after the property is acquired. Let's talk about how to value commercial real estate. So commercial real estate is valued off of cap rates. And so if you look at the income statement from a commercial property, the NOI, which is the rents collected for that property minus any expenses, which could be taxes, insurance, management fees, repairs and maintenance, utilities, contract services. There's a lot of different line items that could be involved in the expense section. So you take the rents minus the expenses, which gives you the NOI. And then you take the NOI divided by the purchase price that they're asking for the property, and that is what the cap rate is. So it's a pretty simple metric. Basically, the cap rate is the cash on cash return you would get if you bought it with cash, which most investors buy with debt. So that metric doesn't equate to the actual cash on cash percentage, but it is a great metric to look at. Another one I like to look at is the stabilized yield on cost. That looks at the stabilized NOI divided by the purchase price, any capex. That gives you a very good understanding of the you'll be able to create in a property. And that's a more complex metric, something you don't really need to know right at the beginning, but it's definitely something good to learn and to track in your underwriting. Another metric is the debt service coverage ratio. This is just the ability of the property to service the annual debt. So you take the NOI, which is the total annual income, divided by the debt service amount, and you have your DSCR coverage ratio. And I'll give you an example of it here. So let's say you have an NOI of 125,000 and your debt service is 100,000. So you would take the 125,000 divided by the 100,000 and you would get to a DSCR metric of 1.25. So the lower your DSCR is, the more risky your property is, just because of the ability to service the debt. As your number gets lower, the property's ability to service the debt gets lower as well. Another metric when it comes to loans is the LTV. So this is also a simple equation. Take the loan amount divided by the purchase price, and you have your LTV. So let's say you're paying $100,000 for a property. The LTV is 70%. The loan amount would be $70,000. So that's a pretty simple metric to look at as well. Let's get into some of the return metrics. So you have annual average return, or average annual return, which is the total return divided by the number of years in percentage. And a good percentage to look at as an LP is around 20%. The IRR is the same thing. It's just the time weighted return. So this is usually less than the average annual return. It might be, if you have an average annual return of 20%, your IRR might be around 15 to 16. So a 15 to 16% IRR is typically considered a good investment for an LP. Cash on cash returns are the cash flow divided by the initial investment. So a good cash on cash return for an LP investor on a Class C property might be 7%, while on the Class A, you might be okay with a lower return, let's say around a 5% cash on cash return. It just varies from investment to investment, and also varies just depending on what your investment goals are. Let's talk about some splits and structures. So there's different ways to structure commercial multifamily. Some people do JV structures where there's the operator on one side of the deal, and then you have maybe a large check writer coming in and funding the whole deal as a JV partner. There's a lot of benefits to doing a JV. Just the legal costs are a lot less than structuring a syndication. Just less investors to deal with. So that is a great way to go. In syndications, you have the LP-GP structure. So typically, the GP ownership owns 20 to 30%, and the LP side would own the remainder. So it would look like a 20 split or a 30-70 split. Just depends on how it's structured. Preferred return. So a lot of syndications pay a preferred return, where the LP gets a certain percentage of the cash flow before any of it is promoted to the GP side. So let's say there's a 7% pref. The LP gets the 7% preferred return. So they would get all the first 7% of the cash flow, and then the remainder would be split in the LP GP structure, which would be the 70-30 or 80-20 split, or whatever the operating agreement entails. So how does the LP make money? I get this question a lot. The LP makes money for the JV partner that brings the capital. They make money by the cash flow that the property provides, as well as a sale or a refinance upside. So if you own 70% of a property, you get to participate in the upside on the sale or the refinance of the property, which is a great investment. There's a more risk involved on the equity side. Therefore, that is why the LP can participate in the upside of the deal, because there's more risk involved in being common equity on a capital stack. That is kind of a brief overview of commercial real estate, a little bit of how it works. I'd love to go more in depth on that. I know I just covered the basics. So if you have any questions, please leave them in the comments or send me a DM. I'd love to talk more about this with you. Stay tuned for more commercial real estate, uh, specifically multifamily real estate tips, also strategies, just some how-tos and different metrics that are used to describe different things in multifamily. So thanks for watching. Remember, future is bright. Keep climbing, and I will see you on the next one.